Good morning, all. Good morning. Welcome to the second class, second day on financial management. Today, we will be talking about some of the topics like capital structure, cost of capital, cost of equity, and investment decisions. These will be the major areas we'll be discussing and sharing and learning in the financial management module. Please give me a second. Let me share the screen. Can you all see my screen? Can you see my screen? Can you hear me? Yes?
Yes, doctor.
Okay, thank you very much. Thank you. So we start with capital structure. Capital structure, having an appropriate capital structure is very important for a business. Business is for profit. Business is for making money using the resources and the services for a company's perspective. Okay, for investors, the capital that they invest, they share with the corporation or company, they expect return. So from the perspective of the company or corporation, or also from the perspective of the investors, they both look towards one goal, that is profit. In the long run, it leads to profit maximization of financial management. So today we will talk about capital structure, which is one of the important key areas in financial management. To have an appropriate structure, appropriate proportion is very important. And therefore, I have taken this topic in the morning when we are little more fresh. Let's now watch this video, which gives.
What's up, everybody? Welcome back. Patrick here. We're now going to move on to the next chapter in the course, capital structure. And this is a big chapter. I consider this chapter in the same category as other large chapters that we did before.
After listening to
budgeting
this,
or weighted
I
average
will
cost of
proceed.
capital. Basically, these concepts are going to affect the company on a very large scale. So let's do a little quick review of the biggest concepts that we've covered in finance so far. So what happens is that you want to start a company, so you go in the market and you raise a mix of debt and equity. You take that money, you buy some assets for your company, and then hopefully your assets are making you some income. So then what happened was we got a little bit more specific with this balance sheet here. So we went into the debt portion and figured out how to value the most common form of debt, which was bonds. So there was a whole chapter dedicated to just valuing bonds. And then the next chapter was dedicated to valuing the most common form of equity, which was stocks. Then we went over how do we grow our company? How do we grow this asset side of the balance sheet? Well, we do that by taking on positive NPV projects. That's what will give us long-term growth of our company. And we went over in detail how to find the NPV of projects in the capital budgeting chapter. Now, this money that we received initially to buy our assets and start our company, we're not going to get that for free. We have to pay back these debt holders, these equity holders. So these debt holders, we have to pay them back a cost of debt. These equity holders, a cost of equity. And then what we did was we took an average of how much all of this money is going to cost us. So we took an average of the cost of debt, average of the cost of equity. Also, if there's preferred equity, we included that. And we found something called the weighted average cost of capital. And in this chapter, we're going to further work with this right side of the balance sheet. And more specifically, we're going to be answering this question in this chapter. What capital structure, which another way to say capital structure is what mix of debt and equity will maximize firm value? right? So capital structure, different companies can have different capital structures. Maybe one company will have a 10% debt, 90% equity capital structure. Another company may have a 30% debt, 70% equity capital structure. So another word for capital structure is basically the mix of debt and equity on that right side. And we want to figure out what mix of that debt and equity will maximize firm value. Well, you may be thinking to yourself, well, don't we just maximize firm value by taking on these positive NPV projects that will ensure that our assets are growing? And that's true. However, that is only looking at the left side of the balance sheet. There's also things that we can do on this right side here that can help us maximize firm value. And if you remember, this right side is basically the sources of capital. And then we have to pay back these debt holders, these equity holders, this weighted average cost of capital. Well, if you think about it, if we can lower this weighted average cost of capital, meaning the sources of capital are fairly cheap for us, we don't have to pay back as much interest or as many dividends or as many capital gains on this equity side, then that's also going to maximize firm value because we're going to have more cash left over to invest in these positive NPV projects. So it's like an indirect way of growing the firm. So we can actually add on to our question before. So what capital structure, what mix of debt and equity will maximize firm value or minimize the cost of capital or the weighted average cost of capital? Now notice how we can play around with this right side of the balance sheet here. We can change this mix of debt and equity without affecting the left side at all, keeping the assets consistent. So we can always change up this debt to equity ratio whenever we want. So for example, let's say that we want to lower the debt to equity ratio. So this debt to equity ratio, maybe I'll show it like this. So it's like a numerator over denominator. So if we want to lower this ratio, what we can do is we can lower the numerator, so we can lower the debt, or we can increase the equity, right? Because increasing a denominator makes the whole ratio go down. So we can do both of them at the same time. So increase equity, the way we would do that is we would go in the market and we would issue more equity. So there would be more equity holders here. We get money from them, and then we can take that money and we can pay off our debt or some of our debt. So we're simultaneously increasing equity, issuing new equity, and then lowering the debt by taking that money and paying off some debt. And then notice how we didn't do anything with the assets. We just changed this capital structure here on the right side. We changed the debt to equity ratio. Now, what if we want to do the opposite? What if we want to increase this debt to equity ratio? Well, what we can do is we can increase the debt, so we can increase this numerator, and we can also decrease the equity, decrease the denominator, because if you decrease the denominator, that whole ratio is going to increase. So the way this would work, if we increase debt, what that means is we are borrowing more debt. So we would go and borrow. I'm not going to write more, let's just write debt here. So we're going to go borrow debt. And then with that money that we get from these new debt holders, we're going to go and we're going to repurchase shares. And repurchasing shares, if you remember, is just the same thing as like paying back shareholders. It's just another fancy way of saying paying back shareholders, repurchasing shares. That's what that means. So borrowing debt, we're taking on more debt, we're increasing the debt, increasing that numerator, and then we're repurchasing shares or we're paying shareholders back. So the equity portion is going down, so we're decreasing this denominator, and overall this would increase our debt to equity ratio. So notice how we can play around with this right side here. We can change the capital structure fairly easily with these steps whenever we want without affecting this left side. The question is, what mix of debt and equity is going to maximize the firm value or minimize the weighted average cost of capital? And that's what we're going to be answering throughout this chapter. What's up, everybody? Welcome back. Patrick. What's up, everybody?
Good morning. So the trick of the trade was explained in the previous video. We just saw for 6 minutes capital structure. Okay. And the goal of any business is to increase the firm value or maximization of the wealth of the shareholders of the business. And for that, capital structure plays a crucial role. And in playing around with debt and equity, in other words, bringing down the WACC, weighted average cost of capital, down, also by valuing the assets, investments, where we can get more. These are all some of the techniques, tools used to get maximize the firm's value. Okay, so this was the video, short video about the lecture now. Now, what is we will also cover WACC elaborately, the investment decisions, how we can value whether to go for it or not to go for it. We'll be studying elaborately in a little while. Before we stepping into, let's try to understand the balance sheet and figure out where exactly this one fits into debt and equity. Remember, the proper appropriate mixture will increase the firm's uh, firm's wealth, increase the wealth of the shareholders. The value of the business will increase. Okay, so what should we have ideally? The capital structure. So on the left side, you have liabilities. On the right side, you have the current liabilities and current assets. Okay, in the slide before, you have the current assets, the fixed assets, which is not mentioned here. Next slide will mention the current liabilities. Below, you have the capital structure mix. The capital structure mix consists of debt and equity. We just saw in the slide. Now, what is financial structure? To understand capital structure, first we need to get the broader picture of financial structure. Financial structure includes capital structure plus current liabilities. Capital structure plus current liabilities consist of financial structure. So what does it conclude? Capital structure is equal to capital structure is equal to financial structure minus current liabilities. So financial structure will include current liabilities. Capital structure will not include. That is portrayed in a different form, the foundation, the expansion, how you can have the mixture, how you can have the mixture of debt and equity, debt and equity. Capital structure. In a broader sense, it can be defined as a mixture of owned capital, equity, reserves, and surplus. Borrowed capital, which is debentures, loan from banks, financial institutions. Remember, the objective of financial management is maximization of shareholders' wealth. Okay, so now to increase the maximization of shareholders' wealth, we need to plan. Okay, we need to plan the capital structure. This is highly psychological, complex, and qualitative process. It is the decision of the managers, decision of the owners play a vital role. A kind of subjective role plays a vital role. It involves balancing shareholders' expectations. Shareholders, when they invest money into your business, they expect certain return. They expect certain return. Also, they are also aware of the risks. They are also aware of the risks. Components of capital structure. equity and debt, the big word that we use. The equity is received from the shareholders' funds, equity capital, preferred capital, return earnings, borrowed funds from debentures, loans, public deposits. The optimum capital structure. Optimum capital structure is the capital structure at which the market value per share is maximum and the cost of capital is minimum, ultimately increasing the value of the share price. Google did not give dividend for many years between 1985 to 2000. Without giving dividend to the shareholders, they kept on increasing their business. Now the share price is very high. So why important? Why so important? Because it enables one to optimize the value of the firm or its WACC, weighted average cost of capital, by finding the best mix between debt and equity for the amounts of debt and equity. Provides a signal. Okay, the structure, capital structure provides a signal to others, outsiders, of course, for the insiders, to the owners and the financial managers, also to the shareholders. What sort of capital structure mixture a company is maintaining? That is, people look at it. Determinant of capital structure. Of course, it depends upon the company, size of the company, size of the firm, the stability of the earning, the stages of life cycle of the firm, short term, longer term, cash flow ability of the firm, cost of capital, how much they incur to get the cost, get the capital, rate of tax, the country's tax, retaining control, flexibility, trading on equity, legal requirement, assets, structure, nature of investor. We can broadly put it into two categories. One is internal factors, another one is external factors. Factors that are affecting internal factors: financial leverage, risk, growth, stability of the business, retaining control, cost of capital, cash flows, flexibility, purpose of finance, asset structure. These are all some of the components of internal structure that affects the cost of capital structure, your capital structure of a business. The external size is size of the company, nature of the company, nature of the investors, cost of inflation, legal requirement, period of time, level of interest rate, level of business activities, taxation policies, stock prices, conditions. So you as a finance controller, you as a business owner, trying to stabilize your capital structure, but this also depends upon the external environment. Given the external environment, external condition, it is the duty of the business owner, duty of the finance controller or finance manager, CFO, whoever it is of the company, should make a appropriate sound decision to fix the capital structure. And from this is going to lead to profit, to maximization of the shareholders' wealth. Now, to understand, we need to assume few assumptions. There are only two sources of funds, debt and equity. Okay, there are the assumption that holds for capital structure are two, debt and equity. The total assets of the company is given and do not change. Investment decision will be constant. Given the assumption that the investment decision that you make is going to be constant. Total financing remains constant. The firm can change the degrees of leverage. Earning before interest and tax EBIT are not expected to grow constant. All the investors are assumed to have the same expectation about the future profits. Okay, remember, all the investors are assumed to have the same expectation about the future profit. These are all assumptions with which it is worked out. Business risk is constant over time. The company has infinite life. Okay, dividend payout ratio is 100%. Given these assumptions, it is to be worked out. Value of the firm depends upon earnings of the firm and its cost of capital. The purpose is to reduce the WACC. Okay, they reduce the percentage of WACC. Earnings are a function of investment decision, operating efficiencies, and WACC is a function of capital structure. Value of firm is derived by capitalizing the earnings by its cost of capital. Value of the firm varies due to changes in the earnings of the company or its cost of capital or both. Capital structure cannot affect the total earnings of a firm, but it can affect the residual shareholders' earnings. Okay, these are all some of the assumptions that we saw to bring out the best capital structure, just playing around or adjusting between debt and equity, in effect bringing down the WACC and also investment decision, okay, valuing the assets and increasing the value of assets. Now we will get into some of the techniques, okay, theories or some of the tools that are used for capital structure. The four theories, famous theories talked about in all the financial management books would be net income approach, net operating income approach, traditional approach, Modigliani and Miller approach. This is approach. There are four famous approaches. There are other minor approaches. We will be focusing on these four. Now, this approach, net income approach, what it is? This is a theory was propounded by David and fixed theory. It is called fixed KE. KE is, okay, according to NI approach, net income approach, both the cost of debt and the cost of equity are independent of the capital structure. They remain constant regardless of how much debt the firm uses. As a result, the overall cost of capital declines the firm and the firm value increases with debt. This approach has no basis in reality. The optimum capital structure should be 100% debt financing under this approach. Remember the word, I repeat, 100% debt financing under this approach. Just now in the initial video, beginning video, what should be the proportion we saw? Assumptions of net income approach. The KD is cheaper than KE. KD is cost of debt and KE is cost of equity. Corporate tax has been ignored. The KD and KE remains constant. These are all some of the assumptions of this theory. This approach so sample sum is worked out. Calculate the value of the firm and WACC for the following capital structure. EBIT, some of the informations are given. KE 10%, KD 6%, debt capital 500,000 and debt 700,000, debt 200,000. How do we work it out? It's all worked out and shown just to highlight. There are three cases, case 1, case 2, case 3. If you look at the case 1, 2, 3, and if you horizontally walk through from case 1 to case 2 case 3, when you come down to the last WACC, weighted average cost of capital, you see the difference. In the first case, it is 9.09%. In the second case, it is 8.77%. And in the third case, in the bottom, 9.62%. See, note the difference. Under the same approach, for 3 different cases, you have 3 different WACC. Why? Because it is because of the value of equity and the value of debt, the value of debt and the value of equity. In the first case, the value of equity is 1700,000. Okay, and in the second case, it is 1500,000 and 80,000. In the third case, it is still higher. In the first case, it was higher. In the second case, it is lower. And in the third case, it's still higher. Now move on to the value of debt for 3 cases. In the first one, 500,000. In the second one, 700,000. In the third one, 200,000. It is because of this nature. The proportion of debt and equity is leading to the WACC. That's what I would like to point out from this slide, which was also spelled out in the initial video that we saw. Now, second approach, net operating income approach. This theory also founded by David, the previous person, net income approach. This is called irrelevant theory. According to this theory, the value of the firm and the weighted average cost of capital are independent of the firm's capital structure. In the absence of taxes, previously we saw no tax. In the absence of tax, an individual holding all the debt and equity securities will receive the same cash flows regardless of the capital structure, and therefore value of the company is going to be the same. Assumptions of this theory. Again, the corporate tax does not exist. Business risk at each level, debt equity mix remains constant. Equity shareholders and other investors, the market capitalizes the value of the firm as a whole. The split of total capitalization between debt and equity is not essential or irrelevant. If you focus and pay attention, there are few unnatural things like you might wonder. The first thought that might come to you is it possible to have these assumptions? Is it possible that it is real? Okay, it looks okay, we study, we assume, but is it going to be real in the real life? This is according to the accounting standard, IFRS standard, GAAP standard, that these assumptions are kept. An example to point out, calculate the value of the firm and cost of equity under net operating income approach. Okay. Again, we have 3 options or 3 cases. Okay, we have 3 cases, and the WACC is kept at 10%, and the EBIT also is same for all the 3 cases, 3 options. The value of the firm remains the same. Value of debt at 6%. Value of equity, the balancing figure differs, and interest is kept at 6%, and EBIT interest differs, and hence the cost of equity is different. That is because of the mixture that is seen outside, the value of debt and value of equity. value of debt and value of equity. Whichever one apply, whether you apply the first approach, second approach, from the exam point of view, you will be asked which approach to apply. If it is not asked, you can proceed with the approach that you are more familiar with, more comfortable with for the exam point of view. The third one is approach without tax. is Modigliani-Miller approach. Approach states that firm's value is independent of its capital structure. The total value of the firm must be constant irrespective of the degree of leverage, that is the debt and equity ratio. With personal leverage, shareholders can receive exactly the same return with the same raise from a levered family firm and an unlevered firm. Thus, they will sell shares of the overpriced firm and buy shares of the underpriced firm. This will continue till the market prices of identical firms become identical. This is called arbitrage. Now, without tax, approach with tax. The previous one was with proposition 1, same without tax, proposition 2. The cost of equity for a levered firm equals the constant overall cost of capital plus premium. That equals the spread between the overall cost of capital and the cost of the financial leverage to be irrelevant. The overall cost of capital must remain constant. Hypothesis with tax. Under current laws in most countries, the debt has an important advantage over equity. Interest payment on debt are tax deductible. The aggregate, the unlevered cash flow plus an amount equal to the tax deduction on interest. The firm will borrow the same amount of debt in perpetuity. Assumptions of approach. Perfect capital market. Some of the assumptions are too ideal, it may sound like. No transaction cost. Homogeneous risk class. Risk in terms of expected EBIT, earning before interest and tax. 10% distribution of earnings to shareholders. No corporate tax. Let's look at one worked out example. Levered farm, value of levered farm is 110,000. Equity is 60,000 plus debt is 60,000. KD is equal to cost of debt is equal to 66%. EBIT is 10,000. Investor holds 10% share capital. In an unlevered firm, value of the unlevered firm is 100,000 all in equity. Please note all in equity. EBIT is 10,000 and investor holds 10% share capital. Something to look at, return from levered firm. Two types of firm is compared here. Investment is 10%, return is 10%. Alternative strategy, sell shares in L, levered firm. Borrow personal leverage 10%. Buy shares in unlevered firm. U stands for unlevered firm 10%. Return from alternative strategy. Investment 10,000. Return 10%. Less interest on personal borrowing, which is 10%. Net return, you get this 700. Cash available, finally 1,000. The fourth approach, which is used in financial management, is traditional approach. This is founded by Ezra Solomon. It's a midway between the two extremes, net income approach and net operating income approach, the first two approach. According to this approach, this theory, A firm can reduce overall cost of capital by increasing the total value of the firm, by increasing the debt proportion in the capital structure to a certain limit. Because debt is a cheap source of raising funds as compared to equity capital. Some of the assumptions. Traditional approach. Oh, this shows on the right side. Okay, from the side. EBIT is 150,000. Presently, 100% equity finance. Note it is 100% equity finance. With KE, cost of equity, is equal to 16%. Introducing to debt to the extent of 300,000 at 10% interest rate, or 500,000 at 12% interest rate. Okay, so we have case 1 and case 2. Case 1 and case 2. Just look at the debt component. Just look at the debt component. Okay, and the interest rate difference. Case 1, 10%. Case 2, 12%. We have to look into the options which is going to be suitable for our business. And finally, when you come the cost of equity, KE, somewhere in the middle, it is 16%, 17%, and 20%. Okay, and finally, you reach the WACC, weighted average cost of capital, which is 16. It was 16%, and now it goes down to 14.91, 15.79, which means you have to decide whichever gives you the lower WACC you would choose. You will choose case 1, that is 14.91. That's the trick of the trade. Points to consider while planning.